The CRA is watching you, and they're not watching you for the reasons that you actually might think. They're watching what you're doing with your tax-free savings account, and they're waiting for the opportunity to pounce and take its tax-free status away. Yeah, you probably haven't heard of this before, but if I walk down the street today and I asked Canadians one simple question, what does TFSA stand for? Most of you are going to give me the exact same answer. In fact, I would say almost everyone would answer me in the same way. Chris, it stands for Tax-Free Savings Account. And if I asked what that actually means, most people would look at me squirrely probably and would say, Chris, for God's sake, man, it means what it says. It means I can invest my money to a certain limit every year, grow it, and never pay tax on it. That's what we've all been told anyway. That's what the name would suggest, isn't it? But what if I told you there are circumstances where the Canada Revenue Agency can decide your TFSA isn't actually tax-free after all? Not because you did something bad or you were out there committing fraud, not because you lied, not because you hid money overseas, but because they believe the way you invested it crossed an invisible line that they decide without any actual rules, a line with no published number, a line with no maximum trades, a line with no exact dollar amount attached, just a collection of factors that could lead the Canada Revenue Agency to conclude that your investing had become a business. And that's only one of several TFSA rules millions of Canadians have never been told. So today, we're going to tap into all those truths as we always do, and it's the truth behind Canada's most popular investment account. Let's tap into the truth.
Welcome to Bakes on Things.
Welcome back to Tap the Maple here on Bakes on Things. It's a doozy with the tax-free savings account here this morning. Don't forget to like, subscribe, and join the conversation. Have you actually run into these rules yet? Before we criticize anything, let's acknowledge something that is actually important. I have a TFSA, okay? I use it. The TFSA is one of the best financial tools Canada has ever introduced. I'm not slapping it around and calling it a bad thing. Seriously, it is a useful tool. It has helped millions of Canadians save for retirement, emergencies, education, a home renovation, simply without paying tax on the wealth that it grows. Unlike an RRSP, you don't actually get a tax deduction when you contribute into these things. Instead, you contribute with after-tax dollars, which means that the growth from there, like the interest, the dividends, capital gains, anything that is attached to this TFSA, most of the Canadian dividends, I should say, rather than just dividends in general, let's make sure that caveat's in there, they generally grow tax-free while they remain inside the account, and qualifying withdrawals are generally tax-free as well, which could be an incredible benefit if you've used it right. If you don't already have a TFSA, learning how to use one wisely is one of the smartest financial moves any Canadian can actually make. But tax-free, quote-unquote, doesn't mean without rules. And that's where many people get caught by surprise, especially with the first of many rules I'm going to give you today. I'm going to give you five rules that you may not know about the TFSA that could get you into some trouble, but the first is the biggest. Let's imagine two Canadians, okay? Both start with $30,000 inside of their TFSA. Both are talented investors. They work that $30,000 and both grow that money to, let's say, $300,000 for easy math. Same account, same profits. One pays no tax. The other potentially faces a reassessment if the CRA concludes that the TFSA was carrying on a securities trading business. Now, you might be sitting there going, Bakes, how in the world is that even possible? Because Canadian tax law distinguishes between investing and carrying on a business, and the CRA evaluates TFSA activity using factors developed through legislation, administrative guidance, and court decisions from before the TFSA even existed. Here's the part that surprises people as well. There isn't an actual hard and fast rule around this particular fact. More than 100 trades? Doesn't matter. That's not necessarily a rule. Or more than $500,000 in the account? No, that's not a rule either. Or holding a stock for less than 30 days, then selling it off? Still not one of the actual written rules. Those bright line rules simply don't exist. Instead, your CRA agent looks at the overall picture. How often were you trading? How long were you holding the investments? Were you trying to profit from short-term market movements, despite what your expertise might be or not be? Did you spend substantial time trading? Did you have specialized knowledge and you're taking advantage of the system? And were you financing trades? They even ask, did the activity itself resemble a commercial business? No single one of those factors will decide the outcome, so for every Canadian, it's different, and that's not fair. It's the combination that matters, and it matters depending on the CRA reviewer. That means two investors with similar portfolios could be viewed differently depending on the facts of the case. Whether that's the right approach is a fair public policy question, don't you think? But it's important to understand that this is how the current framework works, whether you like it or not. You may get reassessed as a freaking business if you're good at investing into your tax-free savings account. It is a wild juxtaposition here. It creates giant uncertainty. Imagine opening a business. Would you accept a rule that said to you, well, we'll let you know in 5 years whether we think you were actually operating a business? Imagine that. You incorporate a business today and the CRA says 5 years down the road, we might reassess and decide you weren't a business at all. Well, you wouldn't be okay with that as a business owner. You'd want to know before you started. That's what many Canadians find very frustrating about this particular rule around the TFSA when they find out. The concern isn't simply that business income can be taxed. Of course it can, if you are a business. It's that there isn't a simple published threshold that tells ordinary investors where the line is drawn by the CRA. Reasonable people can disagree on whether more objective rules would be better, but it's easy to understand why uncertainty makes the investor, like yourself and myself, a little bit uneasy about whether the brown envelope is going to appear in our super mailbox on the street corner. Here's one that catches people off guard every single year as well. Let's say you've already used all of your TFSA contribution room, and today you decide, I'm going to withdraw $20,000 to get a hot tub in July. A lot of Canadians would assume that they can simply just put that same $20,000 back next month with your commissions, your bonus, whatever it is. But not necessarily. In fact, in most cases, the contribution room created by a withdrawal doesn't return until January 1st of the following calendar year. So if you try to do it next month, you're going to get dinged. If you already have used up your room and you deposit too early, look out. The CRA can assess a penalty tax of 1% per month on the excess amount for as long as it remains in excess. People often assume they're just putting their own money back in their account that they took out. But unfortunately, and you may not be aware of this, the timing absolutely matters. Now, there's a third rule that a lot of people seem to not know about this. Not everything is actually tax-free. This one surprises investors who own U.S. stocks, for example. Suppose you own shares in a U.S. company that pays out dividends. Those dividends are generally subject to a 15% United States withholding tax before they ever actually reach your TFSA account. Now, why is this? That's because, unlike an RRSP, in many circumstances, a TFSA generally isn't recognized under the Canada-U.S. tax treaty for that exemption because the TFSA is relatively new. So your capital gains can still genuinely grow within a tax-free savings account, but those U.S. dividends are going to come off no matter what. It's a small detail that can make a meaningful difference over many, many years of investing. Unfortunately, the rules don't stop there. There is a fourth one as well, and that is when people realize they have bought the wrong investment. Not every investment qualifies to be held in a tax-free savings account. The rules around qualified and non-qualified investments can become technical, especially when private corporations or certain closely connected investments are involved. Holding a non-qualified investment can trigger tax consequences, big ones in fact, that could decimate your TFSA or your next tax return. For most Canadians, using publicly traded stocks, ETFs, mutual funds, GICs through mainstream institutions, that's not going to be an issue. But for anyone considering more specialized investments, it's worth confirming whether they're TFSA eligible before you actually buy that particular investment. And then the fifth rule that it seems to be narrowly known across this country is the advantage rules. What the heck are those? Well, this is one of those topics that almost nobody hears about until they're studying tax law. And how many times do you dig into tax law? But the Income Tax Act contains anti-avoidance provisions known as the advantage rules. They're designed to stop people from artificially boosting the value of a tax-free savings account through transactions that Parliament never intended to receive tax-free treatment. This isn't something that affects the average investor for the most part, buying an index fund, for example, every single month. It's aimed at more sophisticated tax planning arrangements that try to get around some of the earlier rules, but it illustrates an important point here. The TFSA isn't a free-for-all. It's not just put it in and everything that grows out of it is tax-free. It's a powerful account with detailed rules designed to preserve its intended purpose. Detailed except for rule number 1, of course, where they can decide one day that you're a business. Unbelievable. But this is where I think Canadians deserve a really good conversation, especially with your financial professional. The CRA has a legitimate interest in preventing someone from operating a full-time securities trading business inside a tax-sheltered account. But are they going way too far? Most people would agree with at least that earlier principle. The real question, though, is whether Canadians deserve greater certainty as to what it would do to qualify, or what they could do to qualify as a business, so they don't do it. Why can't they give you a fairer system? I'll get it out. Would investors be more confident if they knew exactly where the line was? I think so. Or does the current case-by-case approach provide the flexibility needed to deal with very different situations? I don't think so on that front. Whatever your view is, it's a debate that we absolutely must have as a country when it comes to what qualifies as a tax-free savings account or a tax-free growth out of them. The TFSA remains one of the greatest financial tools available to all Canadians. That we're not saying. This episode isn't about discouraging anyone from using one. Talk to your financial professional and see if it's right for you. This is exactly the opposite, though. It's just about learning the rules. It's about encouraging Canadians to fully understand what that account means. Because understanding your rights also means understanding the rules. When governments create programs, Canadians shouldn't have to rely on internet rumors or seeing a horror story about the TFSA on TikTok to figure out how the TFSA actually could work. Clear rules build confidence. Uncertainty creates anxiety. And when it comes to your family's savings, I would think for you and me, confidence matters. Don't you? That's how you tap into the truth. Don't forget to like and subscribe. Join the conversation down below. Have you seen anybody run into these rules yet? And if you haven't, have you at least heard of these rules? And what do you think of these rules if this is the first time you're hearing about it? Let's have that conversation down below in the comments. Don't forget to like and subscribe. If you have any hypes left, let's hype this one up so everybody learns what a TFSA could and could not do to your tax situation. And we will be back tomorrow morning for your Wednesday morning edition of Tap the Maple, 6 a.m. Eastern Daylight Time. For now, have yourselves a fantastic Tuesday, and we'll see you tomorrow.